A week of big moves in the market, a big gathering in Davos, and a big signal from the Fed. But in the end, it was a tragic shooting in a small town in Texas that cast the biggest shadow over it all. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on whether bad news in the markets and the economy is good news for the Fed.
Humility is the right posture with respect to monetary policy.
And Blair Effron of Centerview Partners on whether things really are as bad as they sometimes seem.
I've never seen as murky a period as we're in right now.
Sometimes the biggest events don't move markets, but they do overshadow everything else. And this week, it was the killing of 19 children in their elementary school classroom in South Texas, provoking anger from President Biden.
Why are we willing to live with this carnage? Why do we keep letting this happen? Time to turn this pain into action.
But as much as the tragedy held our attention this week, there was a lot going on elsewhere, like in Davos, Switzerland, where the great and the good of business and finance gathered once again. And we heard about everything, from Madame Lagarde on the odds of a recession.
For the moment, we are not seeing a recession in the euro area.
To Bank of America's Brian Moynihan on the strength of the consumer.
In the first 2 weeks of May, the consumer spent 10% more than they did last May. And that's over top of the payments that went out to pay taxes.
To Fidelity CEO Ann Richards on the global food crisis caused by the war in Ukraine.
One of the things that has been really constructive about the conversations this week is how the risk of a food crisis has gone right up the agenda.
And George Soros on whether the war could end it all.
The invasion may have been the beginning of the Third World War, and our civilization may not survive it.
And while all those bold-faced names were talking in Davos, we got the minutes from the Fed's May meeting, showing that by raising rates now, they may have more flexibility later on.
I'm not sure how much the Fed is really moving this market anymore. This is a market, I think, kind of running on fumes and looking for a direction from anybody, and they're not getting it from the Fed right now.
And whether it was the hint of a let-up from the Fed or just wishing our ways toward better times, the equity markets finally broke their downward trend, with equities across the board up for the first time in 8 weeks. Both the S&P 500 and the NASDAQ were up over 6.5% for the week, giving the S&P its best rally since 2020. And that risk-on sentiment carried over to bonds, as yields on the 10-year gave up 4 basis points, ending the week under 2.74. To take us through what, if anything, we learned from the markets this week, welcome now Ben Inker. He's GMO, co-head of asset allocation, and Ann Sonders, Charles Schwab chief investment strategist. So, Ann, I'll start with you. Are happy times here again?
I think it's too soon to tell. Looking at a 1 week rally after 7 weeks of pretty significant carnage is more indicative of a counter trend move, the types of rallies you tend to see in bear markets. I think it's premature to look at this either from a technical or breadth perspective and suggest that it marks the beginning of a new cyclical uptrend. This is just natural to see this kind of pressure. I think, somewhat ironically, it was the weaker economic data to a large degree that changed the perspective or the narrative as it relates to Fed policy to maybe they have some flexibility to pause after the next couple of rate hikes. But I think it's also premature to make that assessment.
So, Ben, I know that you're a longer-term investor. You don't just look week to week. But did we learn anything about that issue, about whether it's a soft landing or a hard landing from what we saw this week?
I don't think we learned anything that's that determinative. We've seen some evidence that there are parts of the economy that are softening. I mean, it's most clear in the housing market, and that's the place most heavily impacted by what goes on in rates. So, that shouldn't have been a surprise. I'd say from the consumer perspective, the consumer still seems to be pretty strong. We haven't seen strong evidence of the consumer pulling back. So I don't think we've seen anything that should really cause people to have said, okay, great. We're going to have a soft landing. We're not going to have recession. We're not going to have continued inflation problems. But as Lizanne was saying, man, it's been a really long run of the market losing week after week. And markets almost never move for long periods of time just in one direction. There's always two-way volatility.
Lizanne, I wonder what it told us, if anything, about the possibility of a recession. I mean, obviously the Fed in part wants things to slow down. They're not going to get their arms around inflation without some slowdown someplace. And we certainly are seeing some weaker numbers in things like housing, as you mentioned.
So clearly the Fed doesn't want to engineer or drive us into a recession, but they do concede it may be the price in order to narrow the gap between demand and supply. And monetary policy can sometimes be a fairly blunt instrument, and really all they can control right now is the demand side. I think the path to a soft landing would be the supply side easing up, not just supply chain disruptions, but also the supply of labor. And that doesn't appear to be imminent, but I think that's probably the primary path to a soft landing. Otherwise, I think the conditions in place right now, the kind of early deterioration that we're seeing, have the needle pointing a little bit more toward recession than soft landing. The last 13 rate hike cycles, you've had 10 recessions and 3 soft landings. So simple history says that it's more likely this time. And with a 40-year high in inflation and the Fed simultaneously trying to shrink a $9 trillion balance sheet, it's hard to suggest that that points the needle more towards soft landing, but there is a path in that direction.
Ben, I'm not going to ask you necessarily to make a prediction on a recession or even when it might happen, but it must be one thing you take into account as you decide your investment issues that are in front of you. Well, how do you take into account a possible recession right now?
You know, there's 2 things we tend to focus on. One of them we focus on almost all the time. Are there conditions that would make a recession, if we get one, a particularly dangerous one? We look for things going on in the financial markets, evidence of excessive leverage, either on the corporate side, the household side, the financial system side, or an economy that's just been growing in a way that just looks really unhealthy. We don't see any evidence for that now. So even if we get a recession now, I don't think it's going to be that big a deal. And most recessions aren't. They come and they go. Inflation goes up. Unemployment goes up. It's, you know, bad for people who lose their jobs, but you come back in a couple of years, it's like, oh yeah, right, there was a recession. I'd forgotten about that. The thing that I think makes it matter more this time is right now, we obviously have more of an inflation problem in the US than we have had in 40 years. And one of the clear ways that that might go away is if we got a recession. So ordinarily, we don't care that much. Is it going to be a soft landing? Is it going to be a recession? Because either way, it's going to disappear within a couple of years. This time around, I do think the question of whether inflation becomes entrenched and becomes very difficult to get rid of is an incredibly impactful one, not just for the bond market, but for the stock market as well. And so the evidence of the US heading into recession earlier than expected matters more than I'd say a recession normally does.
Yeah, and David, I would agree with Ben. I think this is, I don't want to be so cavalier as to say garden variety recession, but not the kind of crisis-driven recession, not even as we see housing rolling over. This is not a systemic crisis. It's going to bring down the global financial system along with the then popping of the housing bubble. So it's a more natural end to a business cycle, which even if it's not imminent, will happen at some point. And I think the Fed gets that, and they don't want to do anything artificial to try to prevent the natural force of a business cycle, especially if inflation doesn't become contained in the near term.
Ben, as Lizanne says, if the supply situation straightens itself out, we're in pretty good shape because it'll take care of inflation. But if that doesn't happen, where are we? And particularly, people are talking about a couple of supply shocks right now. Certainly energy, given what's going on with Russia, but actually the energy prices were up even before the sanctions against Russia. And of course, food. We're really concerned now about getting grain and other food out of Ukraine.
Yeah, I mean, the food situation is a really important one for the world. And if you think about kind of the poorer countries in the world where food is a big part of the consumption basket, that price rise is an extraordinary social problem. The nice thing about the US and the rest of the developed world is higher food prices for the vast majority of people are a nuisance and a pain, but they're not a life and death problem. With energy and the commodity price increases, it has been interesting, right? This is a supply shock. We've seen prices go up. That often leads to problems in the economy. But the other thing it often does is lead to excessive investment in the commodity space itself and kind of creates the seeds of destruction in terms of falling prices. And there's where it's really been interesting this time around. We have not seen the burst of investment, either on the energy side of things or, because industrial metals prices have moved up hugely. We haven't seen the huge increase in investment there. And that's good if you're going to be buying those companies, because ordinarily the dangerous thing about buying those companies when prices are high is because they make bad decisions and destroy their return on capital. But not necessarily so good as we look forward for the global economy, because we're not seeing the obvious places where more copper, more oil, more natural gas, more iron, more lithium is really going to come from and release that cost pressure coming from the supply side there.
Lizanne, Ben raises a really interesting point. Even beyond commodities, what are we seeing in capital investment? Because we like to see capital investment to have productivity go up.
So short term, I think there's a risk that it continues to weaken here. If you look at capital spending intentions, if you look at the CEO survey of confidence, it suggests that near term there's going to be a constraint. However, if you want to find a bright spot, medium to longer term in the U.S. economy, I think the capital investment side is going to be very strong. In fact, I wouldn't be surprised to see if the consumer as a driver of GDP starts to move down slightly from its current 70% weight. And what picks up some of that decline is business investment, capital investment, and in conjunction with government investment. And I think that's a healthy backdrop for an economy. And it may not be the near-term story, but I think it's a much more powerful medium to longer-term story.
Ann Sonders and Ben Inker will be staying with us as we turn from what the markets did this week to what we should do with the markets going forward. That's next on Wall Street Week on Bloomberg.
The market ended the week in a sinking coma that made it clear that the worst economic shortage of all was the shortage of buyers on Wall Street. It was a week that recalled the words of Otto H. Kahn, the famous financier and art patron who once described finance as an old lady with shaken nerves.
That was Louis Werkheiser, of course, on Wall Street Week back in 1973. Ann Sonders of Charles Schwab and Ben Inker of GMO have stayed with us. So, Ben, I don't know about a nervous widow with dealing with the markets. This week, in fact, it was up, not down. At the same time, the market has clearly been nervous. How do you approach this? And particularly, I read with great interest your talk about a so-called growth trap.
Yeah, I think, as a value manager, one of the things that happens to us all the time, a client comes in or a prospective client comes in and says, oh, you buy value stocks. How do you avoid value traps? And it's a perfectly reasonable question because value traps are a pain for value managers. But what people don't seem to focus on is those same kinds of stocks exist in the growth universe as well, right? A trap is just a company that winds up not doing as well as investors were expecting. And those stocks actually turn out to be more painful if they were growth stocks than if they're value stocks for not such a weird reason, right? If you're a value stock, nobody expected all that much from you. They're still disappointed if you do even worse. But if you're a growth stock, if people were expecting wonderful things out of you because you were Peloton and were going to sell a bike to everyone on earth, when you fail to live up to that, there's two problems. One, your fundamentals are worse, but two, your valuation drops, right? That growth premium you had, you're no longer worthy of. And whether you're Peloton, whether you're Netflix, whether you're the whole series of growth stocks that have turned out to be traps in the past year, one of the interesting things that's gone on in the past months is this has actually been the worst year to be a disappointing growth stock relative to growth stocks. So, right, it's been a lousy year for growth stocks, fine. But the stocks that have done excessively badly relative to the rest of growth are those growth companies that have disappointed. And we think if you're going to be hiring active managers, it's important to recognize they're not going to be right every time. And one of the things that people are only relearning pretty recently is, yeah, it's really painful as a growth investor to turn out to have been wrong on a stock. And we think that that pattern of growth traps doing particularly badly is set to continue for a while.
So Liz Ann, what about that? Obviously, when you talk about growth stocks, there are a lot of things included in that, a wide range of different companies. At the same time, in a world of rising rates, rising interest rates, all the things being equal, which they never are, growth is going to do worse because you're discounting that future cash flow, aren't you?
Well, and especially in an environment where some of these so-called growth stocks are actually the non-profitable stock. They don't have any earnings growth. They don't have any earnings. And I think when you combine that, which those types of stocks, whether it's non-profitable tech, they were very narrative driven. They really represented one of the pockets of where speculative froth was the primary driver. And in this part of the cycle, those types of companies, those longer duration, eternal duration stocks, as you wait for that earnings stream in a rising inflation, rising interest rate environment, get absolutely hammered. The one thing I'd say, and it's a little bit different a take on the idea or concepts of growth and value, and I often describe it as lowercase v and lowercase g, is investing based on the fundamentals or characteristics or factors of growth or value. In fact, Bloomberg does amazing work on factors. And if you look over the last 3 months, over the last 6 months, sort of this era of tighter monetary policy, high inflation, rising interest rates, what's interesting is even within segments of the market that are mostly housed in the growth indexes, tech, consumer discretionary, communication services, it's the value-oriented factors that are working, that are leading, meaning stocks that trade or stocks that screen well on those types of factors, whether it's strong free cash flow yield, strong balance sheet, lower volatility, they've been doing well. So I think sometimes investors have to take off the blinders when they think about growth and value, because you can look for value in areas that happen to live in the growth indexes. And there are times where certain stocks that live in the value indexes don't offer a tremendous amount of value. Utilities, which have been popular stocks because of the defensive nature, are now trading at a record or near record positive or premium from a PE perspective to the S&P 500. That's not value in a traditional sense. That doesn't mean they've become growth stocks. They still live in the value indexes. So that's another way to think about the concept of a value trap, which Ben talked about.
So, Ben, I'm curious about your reaction to that. I suspect you might not entirely disagree because you talked about active investing. You were saying be careful about growth stocks. At the same time, there are these elements such as good old-fashioned cash flow and balance sheet and volatility and stuff like that. Within the growth sector, there may be still some good buys.
Yeah, I mean, well, first of all, there almost always are, right? It would be weird if an entire half of the market, and growth and value tend to be defined by halves, if there was nothing worth owning. So even a year ago, there were probably some growth stocks that were worth owning. And I would say we have a strategy that we've been running for the last year and a half where we're explicitly long undervalued stocks and short overvalued stocks. And one of the things we've found in recent months is some of the stocks we were short a year ago are showing up on the long side of our book because the market has really fallen out of love with them. And that's a natural, that is a natural process. And one of the things about growth and value and that people tend to forget, they are always dynamic strategies. Right? You buy a value portfolio, you come back in a year and some of those stocks aren't value anymore. Now, oftentimes those stocks that aren't value, it's a good thing because the market has said, ooh, this is actually something pretty cool. And the valuation goes up and they graduate to the growth universe. On the growth side, what you really want is for those growth companies that you owned at the beginning of the year to still look like growth companies at the end of the year. Because if they don't, it's probably because something quite bad has happened to them. And that's a piece people don't tend to recognize, especially when they're talking about a stark duration difference between growth and value. It turns out that that dynamism, that rebalancing of growth stocks to value and value to growth means I think people overestimate the duration difference between growth as a strategy and value as a strategy by a large amount.
Lizanne, I want to give you the last word. I always throw you a curveball. Here's a curveball. Is the real answer here we should all lower our expectations from what they have been and what we should expect from our portfolio?
There's nobody that I know out there that does long-term capital markets expectations that has a lofty number in keeping with, say, the 10 years leading up to the pandemic, or even the 10 years up until the end of last year. So I think just where we are in the cycle, the fact that household ownership of equities is, as of the end of the year, even through the first quarter, was at a record high level. That doesn't bode incredibly ill for subsequent 10-year returns, but it does suggest curb your enthusiasm for excess returns.
Okay, many thanks to both Ann Sonders of Charles Schwab and to Ben Inker of GMO. Coming up, we take a look at the week ahead on Global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now for a look ahead at next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. Investors will be looking to China PMIs this week for any hint that growth is bottoming out, even as restrictions in major cities continue. This after Premier Li admitted that China's economy could be facing greater pressure than in 2020, a rare statement that suggests policy implementation may be accelerated. And with the tech crackdown still dragging on sentiment, we'll speak with the CEO and founder of iQIYI, China's answer to Netflix with over 500 million users. Now over to Laura Reich in London. Laura?
Thanks, Juliet. EU leaders convene in Brussels on Monday and Tuesday. High on the agenda, the war in Ukraine, inflation, energy and food security. On the latter, the UK have publicly supported a proposal from Lithuania to restart grain exports through the Black Sea with a naval coalition of the willing. Next Thursday and Friday, UK markets will be closed for Queen Elizabeth's official 96th birthday and Platinum Jubilee celebrations. Romaine.
Markets will be closed Monday for the U.S. Memorial Day observance. The big event, when investors return, will be the June 1st start of the Federal Reserve's decision to shrink the holdings of treasuries and mortgage securities on its balance sheet. Holdings that more than doubled during the pandemic to $9 trillion as the Fed tried to stimulate the economy. Jay Powell has described this so-called quantitative tightening as important for returning financial conditions to a, quote, more neutral calibration. Economic data next week include home prices, consumer confidence readings, and the employment report for May, which is expected to show a 17th straight month of gains for non-farm payrolls. And next Friday will mark the end of an era for Amazon. The company's stock, which is trading at more than $2,000 per share, will be split for the first time since 1999. Amazon, along with Alphabet, are the last two of the 5 biggest U.S. tech companies to have 4-digit stock prices, and Alphabet already made plans to split its stock in July. David?
Thanks to Juliet Sally, Laura Wright, and Romaine Bostic. Coming up, the Fed is taking the punch bowl away. How bad will the hangover be? We'll ask Blair Effron of Centerview Partners. That's next on Wall Street Week on Bloomberg.
We knew it was coming, but somehow it still surprised us. We'd pumped record amounts of dollars and yen and pounds and euros into the global system, all to keep it going through a financial crisis and then a pandemic, as justified by then Fed Chair Janet Yellen.
At present, I view the balance of risks as still calling for a highly accommodative monetary policy to support a stronger recovery and more rapid growth in employment.
And then we added trillions of dollars of fiscal stimulus, including that American Rescue Plan President Biden convinced us we just had to have.
For each dollar this tax cut cost, it returns $8 in benefits down the line. It's a gigantic help. It's an 8-to-1 return.
But now the time has come to cut down on all that stimulus. On both the fiscal side,
we should not put more stimulus spending into the economy because that is what generated so much of this.
And on the monetary side.
If you want to tighten policy, you have to raise interest rates by more than inflation went up.
Leaving us to debate just how bad it could get.
Supply shocks, demand shocks, all together mixed in one. Of course it is unclear at this moment in time.
When it comes to getting a sense of what's really going on in the markets and in the business world, there's one person we really love to turn to, and that is Blair Effron. He is the founder, co-founder, and partner in Centerview Partners. Blair, thanks so much for being with us. So we had a lot of stimulus go into the market, fiscal and monetary. We took it out, and now people are really almost in a panic, some people, worried about where we're going. What is your sense of where we are?
David, first of all, thanks for having me on. And obviously, everything's a lot more murky than last time I was on. So what I would tell you is this. One, I've never seen as murky a period as we're in right now. I think the answer is across the spectrum. We're going to know a lot more in the next 2 months. Let's define first what we're looking for. Everybody talks about slowdown versus recession. Remember, recession, at least by our traditional definition, means 2 quarters of negative GDP growth. I don't think that's going to happen. I do think there's going to be 3 or so data points that we're all going to pay close attention to in the next 2 months that have to show decent result. Obviously, inflation. Let's assume that the Fed funds goal, public goal of 2 to 2.5% is going to look light, and it's somewhere between 3 to 4% before it's all done. To be at the better end of that, you're going to hope to see inflation publishing with a 7 by midsummer and with a 6 later in the summer. Secondly, energy prices. Do they hang in where they are, or do they go higher? That's always going to have a big influence at the pump. I would note that the biggest companies, the oil majors, have not increased their production budgets, which kicks in over the intermediate term. So they're telling you that in some ways today, the belief is it's a big cycle. And finally, where's housing going to be? Mortgage rates up 200 plus basis points in just a few months. The last time we saw that, it cooled housing down about 15%. We need housing to do better. To the extent this all happens, I believe that we will be in a period of slowdown, certainly, but that there's enough tailwind in different parts of the economy to keep this from being going to a full-blown recession.
So we're certainly seeing a slowdown, let's put it mildly, in the equity markets. It's been really a roller coaster, but down substantially this year. Is that translating into your business? Are CEOs less eager to make deals right now?
Absolutely. I would say that the biggest factor in deal making is going to be confidence. And confidence comes from feeling certain in your decision making, certain in the outcomes of various moves you're going to make. And right now we are in an uncertain environment. CEOs can make judgments when there's a high growth environment. They can equally make judgments in a lower growth environment. Right now, it's certainly a difficult period, but things are happening. I tell you, David, that volumes remain okay. It's actually the overall value of transactions is down 35, 40%. And that tells you that CEOs are focusing still on doing moves that are more tactical than strategic, but doing them. And they are getting things financed. I would say, particularly if it's obvious the equity markets, not so, but for investment grade, no issue. And for below investment grade, a lot more expensive, 300 basis points or so higher than it would have been even a few months ago. But given what's going on in the leveraged loan market, which is very robust, taking off a lot of the downward impact in the high yield market in terms of issuance volume, things are actually still, frankly, getting done.
From your experience, from your vantage point, is it possible we're all overreacting?
That's not a word I would use. No, I think this is an environment where, if anything, you want to react aggressively, act aggressively, get ahead of it. I'm someone that certainly thinks, and as you and I have talked about for quite a while, that getting to rate raises had to happen. Would have been Perhaps better happened sooner. There are reasons for that it didn't, but the rate had to happen, and you want the curve to happen steeply. So I believe getting ahead of it, particularly because we had an asset price environment that was just too robust. And it is no surprise that when that happens, you will get corrections in certain areas of the market, violent corrections, to overcompensate. I do not think in any way it is an overreaction. I'd rather see us react strongly so that we can figure out how to guide the economy down, but still keep it in a growth mode. And again, you have a lot of tailwind in different areas to suggest that that is entirely possible.
So as you say, you don't see a recession as of right now. You don't see it in the traditional sense. Some people say part of that's because we're going into this situation of some sort of downturn with much stronger household balance sheets. People have a lot more money in their bank accounts, so to speak. And by the way, the banks are much better capitalized than they've been in some prior areas. Is that possibly a drawback for the Fed, which would require them to go further in the rate hikes because, in fact, we have more momentum going into it?
So first of all, I believe the Fed will do what it needs to do. Jay Powell told you he looked back to Paul Volcker as a personal hero. I took that as a pretty interesting signal. What I would tell you is we're starting, obviously, correct in strong position. The last time, the last 4 big upticks in rates, they went up 300 basis points. They started at a 3% Fed funds rate. Here we started at 0. That gives us, I believe, more cushion than not. I also think the consumer is stronger. Balance sheets are stronger. Obviously, Walmart and Target last week talked about a cost issue, a price realization issue. They didn't really talk about a consumer weakening. They talked about a consumer changing preference, but still staying strong. And then, of course, David, we have employment levels at really historic lows, and we still have 10 million jobs waiting to be filled. I think all of this gives us protection. I don't think, that said, the Fed will, I think they'll be nimble. I think they will act to facts on the ground. And the most important thing, which they've said, and I fully support, is getting inflation back under control. And remember, we still don't know how much of the 8+% is structural versus transient. And the goal at some point, the question is going to be, is 2% the right level to end up long term, or is it something different? Time will tell.
When we look at what the markets have done thus far, our eye is naturally drawn to tech. Tech's really gotten hit particularly hard here. As you look at potential deals for the CEOs that you represent, the CFOs you work with, are they particularly reluctant in the tech area? Has the bloom truly gone off the rose in M&A and tech?
No, it hasn't. It's certainly hard to price things and evaluate things in the current environment, but tech obviously is a huge and growing sector of our economy, of the global economy, and is enabled, frankly, companies across the spectrum to do better. So when I think of tech, I think of every company being a tech company, not just what you might define as traditional tech. I do think, that said, that we've had a return to a traditional valuation metrics. Companies ought to earn return, they ought to have cash flow, and they ought to be valued as such. There was a period of time when that became less important, and I think the market, therefore, is having that correction now. So while it would be hard to do a tech deal as we speak right now, I have high confidence as we get through this period of uncertainty that it will continue to be at the forefront of the economy, and frankly, the forefront of my world.
When the markets were on their way up and we had a lot of various forms of stimulus coming in, a lot of the talk was about environmental, social, and governance, ESG investing of various sorts. I know that's something you've been active in. Has that been put in abeyance for the time being? Is that put off to the side until we get through
Not
this?
at all. That's a great question, but not at all. Most companies across the spectrum, including energy companies, I think are more committed than ever, and in all 3 aspects of ESG. And you see commitments being made. I think that that is seen as responsible corporate citizenship. Stakeholders demand it. And frankly, the best companies figure out how to give a great financial return to their shareholders, and also a great return on ESG. And if you think about what it means for recruiting, if you think about what it means for customer satisfaction, United Airlines can talk to its customers about the kind of green fuels, biofuels it's using, it makes a big difference. So by no means has it been on the back burner. And when I see that there are cutbacks in certain discretionary spends, it's not in that area. It might be in advertising and promotion, for example, where I do see some already cut back. It might be modestly in tech. I already do see cutback, but it's not going to be in the ESG area.
Okay, Blair, it's always such a treat to talk to you. Thank you so much for your time. That's Blair Effron of Centerview Partners. Coming up, we wrap up the week with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David West, and we want to wrap up the week once again with our very special contributor, Larry Summers of Harvard. And Larry, we have a lot to talk about when it comes to the economy with respect to markets, but I want to start with something very different, and that is what we saw in that tragic shooting down in South Texas in that elementary school. I'd like to say it's unimaginable, except it's happened too many times. Do you have any thoughts about what we're seeing in this country?
Horror, rage, frustration. We can do better. We need to think through what the right solution is. Some limits on access to guns that don't threaten any real Second Amendment right. Some red flag set of procedures that catch signs of trouble in people and take actions. We just can't accept this as the regular order of business in America. And I think, David, it reflects something that may be broader, a kind of new callousness in our country. We're probably only in the fifth inning with respect to COVID. There are going to be hundreds of people dying each day as far as the eye can see. And we are not, as a country, making the investments, whether it's vaccines you can take through your nose, whether it's new therapeutics, whether it's a war on long COVID and clinical trials that we need. We've let the COVID controversy become a green eye shade thing about pay-fors and a culture thing about masks, when they're the highest return investments available in our society for here and for leadership around the world. And we just can't seem to get there. And I just don't understand why we can't all come together on the proposition that innocent Americans shouldn't be dying, and that it's government's first obligation in the name of security to prevent that from happening.
Yeah, it's hard to imagine what's going on. Larry, let's come back now to the economy if we could. And particularly we had FOMC minutes coming out this week that the markets took as good news because they talked about raising rates at 50 basis points for 2 or 3 times, and then that gives them flexibility. Has the Fed already accomplished much of what it has to accomplish with respect to inflation?
I doubt it, but I'm not sure. I think the Fed's flexibility is a much better place for it to be than all this emphasis on forward guidance that we were having for a long time. I think humility is the right posture in with respect to monetary policy. David, as you know, my view has been that inflation's not going to come down without some meaningful downturn in our economy that means an increase in unemployment. But I've been uncertain as to where interest rates will have to go to achieve that, particularly all that's happening that's been adverse for financial conditions in the stock market and in credit markets. But I thought the Fed's posture at last was broadly appropriate, and now the question's going to involve carrying through. But I do continue to believe that a soft landing is an unlikely outcome, and that those who are confident that it will happen, I don't think have a basis for their confidence.
Okay, well, let's talk about the Congressional Budget Office, because I don't know how confident they are, but they came out with projections this week that would sure look like a soft landing to me. They have inflation coming down to 2.3% by 2024. They've got GDP growth at 1.5%. Unemployment still under 4% at 3.8%. And the 10-year only goes up to 3.1%. That sounds a lot like a soft landing to me, Larry.
I've always thought of the CBO as a bastion of credibility. I've watched the CBO projections for 40 years. This is their least plausible one in the 40 years that I've been watching. To be fair, they have to lock that forecast up months ago, and a lot's happened that's been adverse in the last several months. But they are the last holdout on team transitory, on the conviction that somehow we can have the economy overstimulated and still have inflation come way down because the supply side is just going to wonderfully materialize. That's a conceivable outcome. It's a possible outcome. How they could regard that as the most likely outcome is not something that I can understand. You know, David, a good discipline would have been a good discipline for them, a good discipline that I try to use, and I would commend to your listeners, is whenever you have a forecast, imagine that it's way off on the upside and imagine that it's way off on the downside, and see if those two things are equally plausible. And I, for one, don't think that 4% inflation is, I think it's much, much more plausible than 0% inflation 2 years from now. And that tells me that 2% inflation isn't really a best guess.
One of the developments this week was how the United Kingdom is addressing some of the energy cost problems. They're imposing a 25% windfall profits tax on excess profits from oil and gas. We had Mohammed Al-Arian say, you know what, he's not sure it's a great idea, but it's better than the alternatives if they give that money to people who are having to pay more, who don't tend not to be the people who can afford it. What do you think about windfall profits taxes on oil and gas?
I don't know about the British context, but I think in the American context, they'd be a grave, grave error. Today's windfall profits tax is a tax on the return people made on investments that prepared for this contingency. A society that imposes windfall profits taxes is a society that discourages preparatory investments. It's a mistake. If we need revenue, which we do in this country, we should get it by repealing the windfall profits giveaway that was represented in the Trump tax cuts to a substantial degree. And that would enable us also to join the world in the global tax cooperation that was such a great success for Secretary Yellen. I've sometimes been critical of the Biden administration, but I applaud them for having resisted the easy political temptation to windfall profits taxes. That was the courageous thing, and that was the right thing.
Larry, let's talk about how we're trying to get our arms around inflation back here. We always talk about macroeconomics. You're a renowned macroeconomist. What about some of the microeconomics? Things like antitrust policy, something we talked about last week on Wall Street Week. You tweeted about it to good effect this week. Also, for that matter, tariffs. We continue to talk about tariffs with even Secretary of State Blinken coming out and giving a speech this week. Doesn't sound like those China tariffs are coming off anytime soon.
I would say this. Those who say that vigorous competition is central to capitalism are absolutely right. We should be pushing for vigorous competition. Probably the single most important instrument the government has for promoting competition in key industries is maintaining open markets in which foreign companies have access to U.S. markets and can compete with U.S. producers, and which in return for that, U.S. producers get more access to foreign markets. Trade liberalization is central to having competition in the economy, and it should be at the front of any kind of competition policy. If we had not had 17.5% tariffs on infant formula, we would be in a much better position with respect to that issue today. If governments had more sensible procurement policies with respect to infant formula at the state level, we would be in a better position with respect to infant formula today. So yes, I applaud the administration's emphasis on competition policy, but that means we've got to respect all competitors who can help American households.
Okay, Larry, thank you so very much for being back with us this week. That's our very special contributor, Larry Summers of Harvard University. Coming up, telling the truth by accident.
Of Ukraine.
What Freud might say about President Biden's trip to Asia. This is Wall Street Week on Bloomberg. Finally, one more thought. To err is human, to forgive divine. So wrote Alexander Pope over 300 years ago. And our leaders are giving us plenty of opportunities through the years to demonstrate just how divine we all can be. Consider, for example, President Ford during a presidential debate in 1976 telling an incredulous Max Frankel of the New York Times that there really wasn't an Iron Curtain after all.
There is no Soviet domination of Eastern Europe, and there never will be under a Ford administration.
I'm sorry, could I just follow? Did I understand you to say, sir, that the Russians are not using Eastern Europe as their own sphere of influence and occupying most of the countries there?
Or a few years later, when President Reagan in 1984 was getting ready to give a radio address and thinking the mic in front of him wasn't on.
I've signed legislation that will outlaw Russia forever. We begin bombing in 5 minutes.
The Soviet Union condemned the remarks, and his opponent that year, Walter Mondale, tried to use it against him in the election, but we all know how that ended, right? Presidential gaffes are not merely relics of the 70s and the 80s. This week, we had two reminders that they're very much alive and well in the third decade of the 21st century. As former President George W. Bush tried to condemn Russia for its invasion of Ukraine and scored something of an own goal, which quickly was picked up on by Stephen Colbert.
The decision of one man to launch a wholly unjustified and brutal invasion of of Ukraine. Iraq, anyway.
Jiminy Christmas. The one phrase he definitely should never utter for the rest of his life. It's like he's thinking about it all the time and it just popped out.
And then there's President Biden on his trip to Asia when he was asked about the U.S. springing to the defense of Taiwan if it were invaded.
Are you willing to get involved militarily to defend Taiwan if it comes to that?
Yes,
You are.
that's the commitment we made.
Leading some, at least, to take issue, contending that he was committing to take up arms if necessary, rather than merely ensuring that Taiwan can defend itself. And this isn't the first time the president has appeared to go beyond stated policy on Taiwan. It's more like the fourth, reminding us once again of that aphorism of Michael Kinsley. In Washington, a gaffe is when someone tells the truth by mistake. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.